Okay, Mr. Chair, you're good to go.
Okay. Good afternoon. My name is John Crocker. I'm the chair of the Toronto Investment Board. The clerk has confirmed that we have quorum, so I'd like to call meeting number 10 to order and welcome everyone here. The meeting is being held using the city's WebEx technology with members and staff connecting via video conference or calling in. Because we are meeting remotely, we ask for your patience with any delays or technical issues. We do not have any registered public speakers today, and members of the public can watch the meeting on YouTube at youtube.com Toronto City Council Live. I'd like to request that staff keep their video turned off unless they need to speak or answer questions. This will make it easier for me as chair and for those watching on YouTube to observe members as they participate in the debate on each item and during votes. I'd also ask that all members and staff keep their microphones on mute unless you need to answer a question or speak. If any members wish to speak on an item, please make sure your video is on and raise your hand or unmute your mic and indicate your intention to speak, and I will create a speakers list. When voting, I ask members make sure that your video is turned on and raise your hand to indicate your vote. Although we are in different locations and meeting remotely today, the board would like to acknowledge that the land we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Are there any declarations of interest under the Municipal Conflict of Interest Act? If you have an interest, please raise your hand or unmute your mic. Seeing none, I will assume, could I have a motion to confirm the minutes of both our special and regular meetings held on October 7th? Do I have a motion from Sharon? All those in favor, raise your hands. Opposed? Carried. There are 4 items on our agenda today, and I'd like to add a 5th item, which we just briefly alluded to, proposed 2021 schedule of Toronto Investment Board meetings, which is being put forward in a letter from the board secretary. Do you have to put that up now, Sylvia?
Yes, we can put that up. Just 1 second.
So these were the dates that were proposed, and I guess Sharon raised some differences, and now Sharon has changed her mind. So City Council has, as I think we alluded to last time, with all of the chaos surrounding COVID, City Council was very delayed this year in announcing their schedule, and we can't do anything until they act. They have now acted, and so now we can create some dates. So I'll move that the Toronto Investment Board item IB 10.5 proposed 2021 scheduled meetings to its agenda. All those in favor? Opposed? Carried. The first item on our agenda today is IB 10.1, presentation from investment managers. We have 2 presentations this morning. The first presentation was Pier 21, Asset Management Incorporated, and C Worldwide Asset Management. So joining us today are Bo Knudsen, Head of Global Investments and Managing Director, C Worldwide, and Eric Bosse, Senior Vice President, Pier 21. So I'd invite Mr. Knudsen and Mr. Bosse to start their presentation. Over to you.
Thank you, and thank you very much. It is Eric Bosse here talking. We're really happy to be able to present 2020 review for the City of Toronto board performance, as well as a business update. So as you mentioned, Bo Knudsen, Head of Global Investment and Managing Director of C Worldwide, is on the line. And I would turn it on to you now, Bo, for the main body of the presentation.
Yes, thank you very much, Eric. Thank you very much, John, for giving me the opportunity to present here today. I have been in the firm for nearly 25 years and been in the investment management industry and in asset management and looking for good opportunities in the equity markets for more than 30 years. If I may please ask to turn to the next slide, because this gives you a quick overview of who C Worldwide actually is. We were established in 1986 in Copenhagen. I joined in 94, and we are still headquartered, and I'm here in Copenhagen. We are 115 people in the organization, and the global portfolio manager and analyst team numbers 21 people. I think it's fair to say that we have definitely have critical mass, both with our history and our time and experience, being one of the most experienced teams when it comes to global equities. But also with a critical mass of 29 billion in total under management. And if I may turn to the next slide, just to give you a little bit more data on where our focus is. Our primary product is our primary product is global international equities. We are equities only. We focus on equities. And you see our client distribution, you see our client split. We basically service institutional clients across the world, but with a strong base here in Scandinavia. We have early on had to focus on institutional clients, and that's where we come from. If I may take a step back and on the next slide, please. Just think about where you find alpha, where you find and how you find extra returns. And even if it happens from time to time, seeing something that nobody has ever seen before when it comes to discovering a completely new company, new stock, happens very seldom in the world of investment today. It's much more often that we have an interpretational advantage, that we emphasize certain data, certain characteristics of a company, that we emphasize that more than other facts. For example, companies that are focused on having a subscription model built into their business model. For example, a company that services compressors, vacuum systems, where they make a big part of their revenue in the after services of critical equipment in a company. What I want to emphasize we think a very clear opportunity is to always take a long-term perspective when investing. We are founded as a company on that principle. And it fits very well with a world that becomes much more responsible. It fits into a world that thinks very much about being more responsible. That if you have a company that is taking that long-term perspective, it's much more natural in that segment. So that's where we see a opportunity, because there's still a big part of the investor universe, investor base, that is very short-term in their orientation. We belong to, I would say, the extreme end of being long-term when we invest. And if I may ask for the next slide, please. We emphasize sustainability of growth rather than magnitude of growth. And we try to illustrate that on this slide, where we typically go for companies that are moderately to high growing, but never in the area of exponential growth. Most aggressive companies is not a space where we invest. And we think that those types of companies are prone to overvaluation and higher competitive pressures. But we go for and try to find companies that becomes bigger over time, but in a sustainable way. And we seek growth, but with an effective diversification across growth rates, so that we make sure that we get a balanced portfolio in at the end of the day. But very much, I want to very much emphasize that we think that it's not the magnitude of growth, it's the growth, sustainable growth, that is the key driver for investment returns in our philosophy. And if I may turn your attention to the next slide, please. There's a lot going on here, and I will not go into detail here. And I just want to highlight that our ESG journey has been going on for 20 years. Already in 2000 and then also in 2004, we did screening, analysis, and engagement via a Swedish company called GES. And it's been natural for us as a long-term investor to include ESG risks when it comes to the way we invest. And we're very proud to see PRI highlighting and giving us an A+ for listed equity integration assessment, meaning we integrate ESG into the way we operate. I also want to highlight that we, as a European company, are looking into a very interesting year. In 2021, the EU disclosure requirements and regulation is coming, and it'll be introduced in March 2021, where we and other European asset managers have to be very detailed on, in particular, ESG-related issues. And we'll see a lot happening here. And I think that it's probably rather seldom that Europe is ahead, but on the ESG front and sustainability front, I really think that there's something very interesting going on. And we've been on a long journey here on ESG, and we will continue along that road. The next part of my presentation here will be linked to just the portfolio and our fund performance. So if I may ask for the next slide, and then another one to go to the performance overview. It's a short period of time, so it's probably not prone for deep analysis. I'm happy to highlight that we've had a good beginning here with the strategy, and this has been driven by companies that are very much suited for the digital society. So some of the names that have pulled performance in this period, I would say markedly better than the index, has been in the digital space, but it's been rather broad-based. When it comes to material portfolio changes in this period, on the next page, you will see those changes. So we are a manager that doesn't trade a lot. We take, again, a long-term perspective, so we don't do a lot of changes in the portfolio. But we sold our last oil stock in Q2, selling Royal Dutch Shell, because of the challenges in the fossil fuel industry. And as you see here, again, also we have made a couple of adjustments in data companies. We like companies that generates and packages data. We think data, in a way, is the new gold, is a new commodity, but packaged the right way. Data is not a commodity anymore. It's a real asset that you can use. So only few changes, but that's right. That's quite natural for us that we don't do a lot of changes during a year. An overview finally on the portfolio, where I highlight on the next slide, please. There you see the top 10 holdings, and you see a number of US names but also that you would probably be familiar with. But you also see Asian, Japanese, and European names, and with a geographic diversification highlighted on the right side, you see all regions of the world being represented in this portfolio. The final slide in this, the formal part of my presentation, just highlights a bit about where the world we are in. Obviously, and I think we all agree that the world has been through, and it's a very, very sad situation that we've been through and we still are in on so many fronts, both directly with the C-19 but also with the consequences and the social consequences in particular of this situation. One thing that is happening, and it drives the world, is digital. The digital society having been accelerated because of this situation. We now operate and we can now meet, as we do in this meeting, we can now meet and use digital tools, and we've seen an acceleration of that. This could lead to, for some companies and organizations as a whole, could lead to increased productivity and greater innovation. But obviously, we've been through a tough period, and there's not a lot to be happy about. But if you look at then the situation and the consequences, if you go back in history, you'll typically see that situations like this could lead to a post-vaccine lift, but the vaccine is not a cure for demographics, the aging population. The vaccine is not a cure for the increased debt levels in the world. We think that the more likely scenario is when we get past 21 and we can leave the C-19 situation behind us, that we are in a world with slower growth, still low inflation, and lower interest rates, also because the debt loads are rather high, and it's very stressful for governments and companies with higher interest rates, meaning the high debt load is actually it will actually increase the likelihood that governments across the world will not accept higher interest rates. And finally, we highlight quality. And with that, and this is just the last point that I want to make on the slide, that basically quality companies have staying power, and definitely something we emphasize with the long-term perspective in mind. You see on the page you have in front of you now, you see the decision-making team. So the four of us are part of the 21-person team, and we are the ones that are taking decisions on the product. So we are accountable for all the changes in the portfolio. We have worked together as a team for close to it's more than 17, 18 years, where we've all been, and I'm sharing office with Bengt. We are entering we have had office together for more than 20 years. And we work together in a very open environment, together with the rest of the deep team that we have. So that was the formal part of my presentation. I'm sorry I ran over a couple of minutes here, but definitely want to leave room for questions.
Thanks, Bo. At this point, I'll open up the floor for questions from any members of the board. If you can raise your hand or otherwise indicate you'd like to ask a question, that would be great. And don't do it all at once. Colin, nice tie. Thank you for wearing one.
Well, I was told that earlier today in the meeting, I should say I dressed up particularly for the meeting. So I'm going to run with that for this excuse. With that excuse, I dressed up for this meeting. Appreciate the presentation. I think I have been very familiar with Pier 21. And I say that to say I'm a new member on the board, so I wasn't part of these process, but certainly very familiar. Agree with some of the conclusions. I'd have two quick questions for you. One is just building off of the last statement that you made. What are the implications in your mind of that world where the debt levels are much higher, the growth is perhaps much lower, the inflation is much lower, where data is the new gold, etc. And the second, just picking up on the team comment, can you speak just a little bit to gender? How is gender reflected on the team?
Yeah. So we are very much aware, if I may start with the last part of your question, Colin, on gender, we acknowledge our responsibility in improving gender diversity in the global asset management industry. And what we have done recently is taken the decision, and that's a change to where we've been earlier, to hire directly from university, and hence both take our responsibility in taking young people directly from university, even if there will be a ladder to climb before they really start contributing, but still. And then in particular, think about gender diversity when we do that. So we recently, only 3 months ago, actually hired and improved our gender diversity. But it's a challenge for us, and it's something that is a challenge for the whole asset management industry, and we'll try to do our best to move in that direction. When it comes to the debt load, I think that it is a central part when you put together an investment strategy. It's a central part to realize how important the debt levels are, because it has very clear consequences when and admittedly, it's not always safe to predict interest rates. It's an uncertain discipline. You have to have a lot of respect and humility around that. But when you have such high debt levels, it's likely that interest rates will not go up, and that we will live in this low interest rate and unfortunately also low return world, where it is rather difficult to find actually value and actually find growth opportunities. So the companies that are capable of delivering growth, I think, will continue to be valued at rather high levels, where the key driver of returns will come from companies that grows bigger over time. History will tell you that even the index has been driven by rather few companies. So what we are trying to do is understanding that and understanding that there are not so many unique companies out there, but we try to put together a portfolio of what we call sustainable growers, and that way around generate a bit of extra return. But the fundamentals of what I'm looking into is a slower growth and a slower return world. And obviously at this time, here in Europe, in Denmark, you have negative mortgage rates. It's a strange world we are in, and the reflection of that is investors having a harder time getting actually return. But overall, I think there are opportunities out there. You just have to be selective.
Thanks, Bo. Are there any other questions for the speaker? Okay, seeing none, thank you, Bo. And we'll now turn to our next presentation from Fiera Capital and Harris Partners. Joining us today, I believe, is Jeffrey Vilker, from Director of Institutional Sales of Harris, Chris Nolan from Director of Responsible Investing at Harris, and my old friend Barbara Sheehan, Vice President, Institutional Markets, Fiera Capital. Hi, Barb. I'd ask you to try to limit your remarks to about 15 minutes and or less, and then we can open it up again for questions. And over to whoever wants to start.
Thanks very much, John. It's Barb Sheehan, and I will let my colleagues, Jeff Vilker and Chris Nolan from Harris Associates, take it away, given the 15 minutes. So, Jeff, over to you.
Sylvia, are we having technical problems?
Chair, Mr. Vilker is on the call. We don't see any problems.
Can you hear me okay?
Yeah, we can hear you now. We can't hear you now. You may have to do the pitch, Barb. Did you? We can't hear you.
How are we now?
Good.
Good. I went to computer audio. Apologies.
Go ahead.
So, yep, presentation's up. Good to see everybody again, as I mentioned. And if we can just move to the next slide. Just a quick update on assets under management. And I will point out that these are as of the end of the third quarter. But when we move to performance, we're going to talk a little bit about quarter-to-date performance because the snapback has been so significant that as much as we don't like to focus on short-term performance, we need to in this case. So strategy assets, you are in a global all-cap value-oriented strategy with Harris Associates. And strategy assets, as of right now, are at about 10 billion US. And you can see firm assets as of the end of the first quarter were a little over 86 billion US. They sit at about 103 billion US today. Next slide. Thank you. So a quick reminder on how we view value investing, because value means different things to different types of investors. If you recall from last year in our meeting, certainly price and a strong discount to what we believe a company's intrinsic value is. And by strong, I mean 30 to 40% discount is part of any investment thesis that we build up at our firm. The next two philosophical tenets are both related to quality, however. So we look to really find companies with high barriers to entry, that sort of big, wide competitive moat, strong free cash flow generation, above average returns on capital employed. Nothing very nuanced there. When you think about a quality company, you think about a company that can sustain strong growing cash flows over time. That's what we look for. The other piece related to quality would be really partnering with management teams that behave like owners of their business. And in order to do that, they need to grow the business really for themselves. So they need to be aligned with the shareholder, right, in terms of how they're incented by their boards. But more importantly, they need to grow the business on a shareholder basis on behalf of the shareholders. So if you see this dotted line, that represents 90% of what we do at our shop. We are fundamental, bottom-up business evaluators. And so maybe this is a 5-year period of time because we do think in that average holding period, 4 to 6 total years, we do think it over a longer period than many investors. And so this dotted line represents the value of the business that we've determined And of course, we need look no further than 2020 to understand that business values are much more stable than share prices. So that is the market, that squiggly line, with all of its volatility. And we are attempting to get new names into your portfolio, again, at that strong discount. And of course, as the market recognizes what we recognize, we hope, and that share price gets close to that dotted line, we're looking to trim back those positions and put those proceeds, rebalance those proceeds into names trading at larger discounts. And so that is the process. Quality companies, a big part of any thesis, again, is sitting down, in this case, getting on a video call or getting on a audio call with management teams across the globe and understanding what are they doing from a capital allocation standpoint to increase the value of the business on a per share basis. And they can pay out dividends. That's a return of capital. They can buy back shares. That helps out the shareholder. They can engage in merger and acquisition activity, clearly, to build their businesses inorganically. We don't have a bias. We just want to make sure that they're putting ultimately your capital to its best and most efficient use to grow those businesses over the long haul. So this is a very patient approach, because if we look at Q1, and we'll pivot to performance, because it's a very important part of any call, let alone today's. We saw share prices drop in some of our highest conviction names 30 to 60%. Business values do not decline 30 to 60% over most years, let alone quarters. And so what we did during that time period, which was a pretty intense 4 to 6 week period, mid-February through mid-March, is look at every single investment thesis of companies that we hold and understand what the economic downturns brought upon by COVID, what those impacts were going to be to our businesses over the next 12, 24. In the case of a travel and leisure related business like a Hilton and Accor hotels, a Southwest Airlines, a Ryanair, three years likely before we see sort of this return to normality in terms of revenue and EBIT generation. We needed to understand a couple of things. What was going to happen to the business value, number one, and two, could they build a bridge to the other side? Was there enough liquidity? Was there a strong enough balance sheet? Was there access to loan facilities? What were the management teams telling us? We did not make some sort of heroic call in March of 2020 that there would be a vaccine solution coming about. Here we stand in December, let alone maybe even for the next 24, 36 months. That is a top-down call that we are not willing to make. What we do, in fact, is get very close to the fundamentals of our business and do what I just said. Stress test the balance sheets, talk to the management teams. Then we pivot to the portfolio construction and say, how do we get the best values representing the highest weights? And so in many cases, Q1 looked like the market action took down several of our high conviction positions. We trimmed whatever held up relatively well. Think Pinterest, think a consumer staples company like Benckiser out of the UK, think Oracle, Taiwan Semi, a business called Prosus, which has significant ownership in Tencent, a Chinese internet company, Charter, Samsung. Those businesses also had declines in the first quarter, but they were nowhere near as steep as some of the industrials, some of the consumer discretionary, and certainly the financials. So it's our job not to run away from that volatility, not to allow fear to impact our decisions, but instead understand the fundamentals and get those portfolios positioned forward so that they could do what they've done in the last, frankly, the second quarter, the third quarter, and most notably quarter to date. So can we go forward one slide, please? So I apologize because you're going to see a couple different endpoints, and that's because of just how violent the market action has been, frankly, in terms, in a good way. Maybe violence not the right word, but it does describe just how strong the snapback has been. And so I actually pulled attribution on your account as of today, but in order to get this presentation to the city in time, we were only able to pull it through 11/18 of 2020. You see that month to date. So month to date, as of November 18th, the portfolio was up about 18%. This is against MSCI World and World Value. And I also have the ACWI numbers in my head, and they're very similar to the MSCI World numbers. So you can see a really strong
Sorry, Jeff, could I just interrupt? You
Yep.
said month to date 11/18, but the top of the page says October 31st. So
Yeah,
could you just
so-
clarify what date you're referring to? Thank you.
Yes, and thank you for that clarification. Those first three lines are month to date through 11/18. If you go down to the QTD, that quarter to date is through October 31st. So what's really telling there is between October 31st, when the portfolio was down 0.8%, and the 18th of November, that's almost a 20% movement in just that first, again, call it 3 weeks of trading days within November. If we fast forwarded to Friday, the 4th of December, we are now up almost 24% quarter to date, which has us up year to date 8.18%, which compares to the ACWI at right around 12. So let me explain just how, I don't want to say unique, because we've lived through 4 or 5 of these crisis periods in just the last 25 years alone. But we were down 35% in this portfolio Q1. And I described it. It was a lot of financials, industrials, consumer discretionary. Think Daimler, think GM, think Lloyd's, Credit Suisse, think CNH Industrial. These businesses, because they are seen as cyclical businesses, right? Businesses that are very sensitive to economic down and upturns. The market sold these off. They sold off everything, but they really sold off these names. Some of the tech, communication services businesses held up. They held up better. They still were sold off, which actually gave us an opportunity to get our hands on some pretty high quality businesses at attractive prices. But much of what we held went from a 70-80% discount to our view of value to 150 to 160% discount. These things were massively on sale just because of the sectors and, in some cases, geographies that they operate in. And so the reason we've been able to, second quarter we came back, we were a couple hundred basis points above the indices. We were about 21.5% up. The indices roughly 19.5. Q3, we were up 7.5. The indices were up right around 7.25. So you can see that first quarter underperformance was 1,500 basis points. And we made up almost 1,200 of that in this quarter to date alone. And we can't do that without sticking to our knitting. And it is painful. We are very aligned with the City of Toronto in terms of our own individual investments in these products, whether you are the lead PM or you're a client PM, myself. So we feel that. We tend to take advantage of those opportunities by adding to our holdings during those significant downturns, because time and time again, we've seen that a very tested, tried and true sort of process, philosophy, portfolio construction has led to again, what we would term sort of this snapback in performance. So any performance related questions before maybe we take a look at what's in the portfolio? What would be of value now for you?
Well, Jeff, why don't you try to be fairly brief, but maybe cover what's in the portfolio now quickly, and then we'll open it up.
Great. Thanks, John. Thank you. Okay, next slide, please. And let's go up one more so we can get a broader view. Thank you. We are indifferent to sort of geography and sector. We're bottom up. And so we're willing to go wherever we need to go from a sector geo standpoint to find value. We do not allow the benchmarks weightings to inform our portfolio decisions, okay? But you can see here a theme clearly in a global portfolio, which is often 60% US, 40% non-US. We have been underweight to the US for many, many years now, based on where finding the greatest values globally. And Europe, including the UK, this is not all that dissimilar from how we've been positioned for the last several years now. You are seeing an uptake a little bit in EM exposure, whether it be direct EM exposure in a Samsung, an Alibaba, which I mentioned is one of those higher quality names that got into the portfolio this year. So we really like getting, just because we're value doesn't mean we don't look for growth in what we own. We just won't pay up for it. So we were able to add Alibaba this year. And of course, Naspers and Prosus both have a significant ownership position in Tencent. So you see that weighting coming up, but apart from that, still a lot of conviction in the financials, in the industrials. And then if we go up one more slide, we can see the sector exposure. And again, you see those overweights in areas like consumer discretionary, financials, a bit of an overweight in communication services and industrials. We have been underweight healthcare, underweight energy, underweight staples for many years now because we feel as though the value isn't there. And those are the value names, by the way, that held up relatively well in the first quarter because they were seen as a defensive play. Prior to that, they were often seen as a proxy for income where you really can't get income off a fixed income investment, but you can get income off a dividend pair. And so valuations have been driven way up in those areas as people have either had a flight to security, which still even before COVID was happening as a result of great financial crisis overhang, or you were seeing that proxy for a dividend pay, for income through a dividend pair. And so it's been hard for us to find strong value in those areas. And even though we're a value investor that might traditionally be there, again, that's not what informs portfolio construction at Harris Associates. Any thoughts on sort of our sector or geo exposure, or frankly, any individual name that you're curious about?
Well, let's open up the floor for questions, and please unmute your mics and raise your hand so that I can see people. Colin wants to go again. Go
I
ahead,
know,
Colin.
and 2 for 2. I promise that I'll stop with being first with the questions after this one. So again, two questions for you. If you heard my previous questions, I'm certainly going to ask a question about the team. Gender diversity there as well. I appreciate the slides on diversity that you have. Strikes me the vast majority of folks are male, but would be curious to your thoughts on that. And second, just appreciate value investment. Your thoughts on the largest weight is towards financials from a sector perspective, at least based off of the presentation. Just curious on your thoughts given the interest rate environment for financials as a sector going forward, just given where we are.
Yeah, both great questions. And thanks for making me not stand out. I appreciate that. We don't get to wear ties enough in this world. So I am going to take the latter, and I am going to happily have our Director of Responsible Investing, Christopher Nolan, Chris, take the former. And again, both good questions. So we have been asked about our position in the financials really since we built it up coming out of 2011, which gave us a great entry point with concerns around sovereign debt crisis, U.S. budgetary concerns. And then what's continued to play out as a backdrop is exactly what you pointed out. And that's this lower for longer interest rate environment that we continue to find ourselves in. I can tell you we are not making a call on interest rate normalization, particularly post-COVID. anytime soon. It is not that these net interest margins are going to expand as a result of interest rate movement up, that we own these institutions. It is more that even in the most dire of circumstances, one of the most challenging sort of environments, headwinds they've had to face, they're still putting up double-digit returns on tangible equity, 10, in the case of Lloyd's, as high as 15, 16%. They have cut their costs. They have put enough capital on balance sheet, frankly, to survive the situation that we're in now. And that was largely regulatory. That was regulatory changes, but also internal stress testing that they've conducted over the last 10 years. They're emphasizing the higher margin earning pieces of their business. In the case of a Credit Suisse, it would clearly be the private bank, that is, and not the investment bank. They de-emphasize, they take cost out of the investment bank, and they continue to grow net new money in places like Southeast Asia. We also have to remember in a low interest environment that the cost of deposits is also abnormally low, which is a tailwind for them. So it is just how healthy and how hard the ones that we own have worked in the last 10 years coming out of the GFC, that has put us in a position to build up these overweights. They are trading at 0.4 to 0.6 times book value, tangible book value. These are institutions that should be trading at anywhere from 1.8 to 2 times book. And at times they've approached that. They doubled they were re-rated coming out of 16, and they doubled their PE multiples in 1 year. The end of 17, these were very strong contributors. And they pulled back in 18 around macro noise with trade tension and Brexit concerns. And they pulled back in the first quarter around economic slowdown concern. They still, it's what price is what you pay, value is what we get, and we still find strong value in these companies, not the whole sector, but the ones we hold. Does that address it? Okay, Chris, feel free on the diversity side, as well as maybe just a quick 30 seconds on your background. I know we're tight on time.
Sure, thanks, Jeff. So Chris Noland here, Director of Responsible Investing at Harris. It's great to speak to you today. Just very quickly, I joined the firm quite recently, about 5 months ago. My background's in ESG research at MSCI. I also worked at Stanford University's endowment on ESG and manager selection. And my role at Harris is to be kind of an internal resource for the investment team and for other teams within the firm on responsible investing, ESG, proxy voting, and engagement. As well as coordinating our communication with external bodies like the Principles for Responsible Investment and other groups. So one of the topics that is kind of, I guess, under the umbrella of ESG and responsible investing is diversity and inclusion within our own firm. Just as with all our ESG work, this is something which has definitely not just kind of started since I joined the firm. It's been going on for quite a while. In the case of the diversity and inclusion initiatives that we've got going on, this has really come from the top and has been in place for a little while. We kind of established a formal process around diversity and inclusion at the beginning of 2019 with the formation of the Diversity and Inclusion Advisory Council. Actually, it's got some slides in this in the deck. You split to slide 14. It's got some summaries there of what we're doing around this. So this year's been a real kind of ramping up of what we've been doing around diversity and inclusion at Harris. We realize that it's important for us as a firm, that it's important for our clients, that diversity of thought and opinion is an advantage from the point of view of making investment decisions. So we have done things like hire a consultant to work with the firm. Initially did some pilot projects, and then we actually rolled out training and conversational workshops to the whole firm in October this year, which was really, I think, a really great experience for everyone who did that. That's kind of working on diversity within the firm. I mean, in terms of the numbers, about 37% of Harris employees are women, which I think is around in line with the asset management industry as a whole. But it's still something that we'd like to kind of do more on. The area where we feel that we could have the most impact in terms of driving change within our organization, as well as the conversations we're having around our own culture, really comes around the recruitment that we do. And this obviously the human capital that we have is by far the most important asset of the firm. So that's a real focus for us. So we're doing things like, for example, we hired a talent acquisition specialist at the end of last year to help us make sure that we are recruiting the best talent. We've included things like going through job descriptions to eliminate gender biased language, stuff like that. So that's where we feel that the progress that we're going to make in this area is going to be just focusing on making sure that we're recruiting the right kind of the right talent and the right kind of diversity into the firm.
Okay. Any other questions of Harris? Pamela?
Thank you. Sorry, it took a moment to locate the unmute button. I'm just going to poke a little bit more at the financials sector, and I know that you're heavy weighted, and I understood the conviction. What about the erosion? So, there's two things that weigh on my mind. One is the increase of regulation and regulatory oversight globally with, AML, just general, a lot more risk aversion by central bankers. And then the second thing that I think is happening at the same time is the incursion by big tech into what used to be traditional banking services and the like. And how has that played into you're remaining with your conviction or you're changing your perspective? Maybe not the decision ultimately, but how does that factor into your thinking?
Yeah, great questions as well. The regulatory body's intent is usually, it's pretty clear. Certainly in breaking up big institutions that might cause what took place in 08, 09 was part of the goal, and then shoring up balance sheets was certainly another big part of the goal. But there is at times unintended consequences that are less understood. And although this is not part of the thesis, we are seeing as tech becomes a bigger and bigger part, fintech in particular, and how this potential for disintermediation continues to grow. And frankly, that ship has left the port. That's all, we're already seeing that. It has actually in many ways benefited the larger global institutions because one, they can outspend regional banks and smaller institutions. And two, they already have the framework in place to take advantage of it. So we're actually seeing banks like Bank of America and Lloyd's, BNP as well, take market share as a result of some of this disintermediation. It is not to say that it could turn into a buggy whip situation where something moves very swift. We've seen this with digital currency concerns, and we certainly have seen this with the advent of brokerage firms like Robinhood, where you're just seeing this massive influx of day traders, reminding me of the days building up to the tech bubble burst. But any threat to the business, any risk gets priced in again from the bottom up. It eventually hits that multiple, which drives 80% of the value of the business. So I will say we constantly challenge ourselves, talk to management teams, understand what they're doing to address the threat, and then we watch how it plays out in the fundamentals. Because being told one thing, that story needs to be confirmed for us to have conviction in what we see in the fundamentals of the business.
Any other questions for our presenters? Well, if not, thank you, Barb. Thank you, Jeff. Thank you, Christopher. Do I have a motion to receive these presentations? Somebody raise their hand. Colin, all in favor? Thank you. We'll move on to the second item then on our agenda. Item IB 10.2. IB 10.2, Sinking Fund and Long-Term Fund Performance and Compliance Updates for Q3 2020, and it's over to Randy. We also have a cast of thousands of guests here from Aon, led by the illustrious Brian White. So we'll start off with you, Randy.
Thank you, Mr. Chair, and hello to everybody today. This second item, IB 10.2, is a report for information. we've seen this format before. It does give our performance and compliance. It is quite a long report with several attachments. The compliance information, I think, is, I don't know, even about 100 pages. I'm happy to say there's no issues there, and I won't dabble on that. But as the chair alluded to, this is information for the third quarter. I'll walk you through the performance numbers and just highlight several tables in the report, and the cover report is 13 pages. I'm going to talk to the earned income numbers that we've talked about before. This is the number that are actual interest realized, gains, and dividends that we have. It does not include the market returns, the total returns. I'll leave that to Brian to cover at the end. Just flipping through the report. I wanted to point out that Table 1 shows you the size of the sinking fund as of September 30th. There was the asset mix rebalance on September 8th, so you see a little bump up in the fiera and addenda numbers, which we spoke about at the last meeting. Just flipping through again, some of these are either in the compliance or the Aon reports. I'll flip right through table 5, 6 are in the Aon report. I did want to go to the end of the sinking fund section, which is the flow of funds attachment 4. We mentioned this at the last meeting. There's actually 2 pages there, and the first page shows you the maturities, the outflow of funds that we're expecting from the sinking funds. There were no maturities in 2020. However, there's $650 million for 2021. The first chunk is on July 26th for $150 million, and the other $500 million is on December 6th. It actually will give you an idea of what's coming up. We've already spoke to the managers. They're all set for those maturities. The other second page of that attachment 4, there's again a table. I just wanted to point out that since the rebalance we did, there's about $100 million, a little over $100 million of contribution that comes from the city and goes into the sinking fund. We're lining up that rebalance after the very last amount comes in on December 14th, and we're also going to align it with our new manager, which we'll talk about in the next agenda item, to get that money out and in the accounts as well. So you will see a bit of a bump up again in account balances, but we're in good shape there for the sinking funds. Turning to the long-term fund, which again, this is where the earned income really plays a role. Table 8 on page 8 shows you the balance of the overall what's in the investment funds, just a little over $3 billion. Over the June number, it's about a $40 million increase in just 3 months on those balances. Again, just flipping through the report, there is again a number of market value reports. I'll let Brian speak to those as far as the market value. You can see in table 14 on page 11 that it's at the top of it, Q3, we've got earned income for just the quarter of $46.2 million with an earned return on capital, our earned income number of 5.2%. That doesn't include any sort of unrealized market gains, which again, we're really good shape on. And then finally, I'll point to table 15, the very last table on page 12, which shows you the requirement for the city's operating budget in 2020 is $143 million. To date, we've, as far as earned income goes, we're at 119.6. So we're 84% of our target at September 30th. So only another $23 million, which is 16% to go to reach our target from the long-term fund as far as earned income goes. We're in really good shape there, and I would imagine that we will go over on that number. there was the flow of funds from the, we mentioned the long-term fund. We were going to make another injection from our short-term liquidity pool, our short-term fund, back in April, but with COVID, I'll remind everyone, we put that on hold, and it's still under review, and hope to come back to you sometime in 2021 with talk about some flow of funds into the long-term fund. With that, I will turn it over to Aon and talk about the market value or total return performance.
Brian, over to you.
Great. Thank you, Randy. Okay, I should say, too, that I've got Raghav Wadhwa with us and Carlos Jurgis with us as well, part of our team members. So, Jonathan, I think you're the person who is doing the sharing the screen. Is that correct?
Me? No.
No. Sorry, no. I think there's somebody from the clerk.
Oh, yes. Another JC.
Another JC. That's right, Jonathan. I saw.
That's correct, Brian. It's Jonathan.
Right, it is you that's putting it up there. Okay, I thought I saw that before. So can we get on to the discussion guide page? The first page after the table of contents, the page number is missing from that. So just while that's coming up, what we have here is different indices and things like that. The thing that I like to share with people is really kind of big picture stuff that I think is should be a focus of people's attention. And so obviously the thing that's probably in the forefront of the investment community right now is COVID. And the key things that are coming out of that is how it's adversely affecting productivity. There's huge concern in the marketplace about stimulus and specifically the Americans being able to continue a regular regiment of basically supporting the economy. So interest rates and stimulative packages are very important in terms of the consideration going forward. The vaccine that is in the forefront of everybody's mind is certainly there. And actually, interestingly enough, a friend of mine is going to be vaccinated with it this week, which means to me that it's happening. So that's nice. But the reality is that the adverse effect of productivity, I think, is probably going to be a factor for a significant part of 2021 until we get everything back in order. And so I guess the message here, not to be a downer, the message here is that there continues to be a lack of productivity in our economy. We've seen results come out of the UK, Europe, and the US that were disappointing in terms of the amount of people that are being hired back into the marketplace. And so to manage people's expectations, I think that you need to be realistic in how COVID is going to be going to continue to be, I should say, an issue on the go-forward basis. So I think that's important consideration. The next thing that I bring forward to people is really talking about the U.S. election, which, to some people's minds is a little bit of history now because it pretty much looks like Biden's going to be, it does look like Biden's going to be the president. And so that's fine. But at the end of the day, what's going to be the impact on the economy for Biden's basically from his agenda? And interestingly enough, he does have some similarities in terms of Trump's views. He tends to be a little protectionist by the American way. He what's going to be different is that there's lots of things that are in his top 10 list that are really going to cost money. And quite honestly, I'm not sure how much of a priority they're going to be after a fairly long period of COVID, because I just don't think the coffers are going to be there to support what he'd like to do. And as well, as we know, there still is a bit of a question mark in terms of how well Decisions will be made with Congress. Will Congress be on side or not? And we won't find that out until the beginning part of the new year. So these are important considerations, I think, that you have to stand back and look at, because you can get caught in the noise, and that's very difficult. If we look at the chart that's on the screen, and I'm assuming people can see this, but if you have one with you, as I said, it's just the page after the table of contents on the discussion guide document. You can see the performance numbers for the various indices across the page, but I'm going to update you on performance numbers. And normally I would show this in a visual thing like this, but instead, given I'm not able to share my documents, I'll just give you the Coles Notes version. So the Canadian marketplace actually was having a bit of a tough go for the year 2020, but we've seen things pop back in the more recent weeks. And so performance for November and December have been positive in the Canadian marketplace. But more importantly, what we're seeing is the Canadian equity growth and the Canadian equity value perform together. And so where we're still seeing year-to-date numbers that are a little bit lackluster between the growth and the value, that number is starting to show signs of coming back. So we're starting to see value stocks come back. Year to date, in the Canadian marketplace, so year to date to last Friday, so that's December 6th, we saw the Canadian Value Index deliver negative 8%, and the Growth Index deliver a positive 16.3. So a pretty strong difference between the two. If we look at the global spectrum, if we look at the MSCI All Country World Index, in local currency, so to take away the currency effect, the value index came in at negative 2.2, whereas the growth index, and this is year to date, came in at 27.9. So we'll say there's a 30% difference between value and growth. And what we're starting to hear people, investment managers, start to talk about is, oh boy, value is coming back on side. The reality is that we've been in an unusual market, and that there will be a time that these organizations that are fundamentally sound, so we just heard Harris talk about this, that the organizations that are fundamentally sound but dramatically underpriced in the marketplace, they will come back in the sun. And I don't think there's any doubt about that whatsoever. You just have to sit and wait long enough to see it come to fruition. Harsh reality is that value's had a tough time over the last 11 years, quite honestly. It's kind of bounced around quite a bit, and growth has been the stronger of the two. But there will be a time that will change. So let's take a look at performance. And I have, Jonathan, I'm going to ask if you can pop between different pages. So are you able to go on to the Toronto Investment Board Performance Monitoring Report Q3 2020? I believe that's in the list, and go to page 2. And I'll just tell you off the top until we get it on the page here. The total for the sinking fund, the total fund return was 0.9% for the quarter. The benchmark for the total fund, and again, the benchmark that we have for the total fund is derived by the investment policy's asset mix. And you need to be aware when looking at that, you have to take it with a grain of salt, because things like real estate are in and allocations to equities that we haven't quite gotten there yet are in that benchmark. So you need to take it with a grain of salt. So if you look at the top line there, you can see the 0.9% for the total sinking fund. You can see the value added of negative 0.3 or 30 basis points. In the area of fixed income over the quarter, we actually saw both Addenda and Fiera come in fairly close to the benchmark. with Addenda, I should say, outperforming by 30 basis points, and Fiera coming bang in right on the benchmark value. If we move down a little bit further, we look at the performance of the overall equity portion of the portfolio, and you can see that Peer 21, which is the SeaWorld, formerly known as Carnegie, they came in at an outperformance over the quarter of 1.7% with an absolute return of 7.7. The Oakmark, now I should tell you that there's often name confusion, even in Oakmark and Harris, over what name to go by. And during the presentation, it's interesting, I was seeing Oakmark pop up and I was seeing them talk about Harris. The reality is that there's a branding exercise that needs to be done by that organization. There was a corporate transition that happened, I think it was at the end of 2019, and they still haven't resolved what they want to call themselves. The formal custodian statements that come through are, say, Oakmark. So the data feed that we get says Oakmark, and we have Oakmark on our reports. I've asked Raghav to coordinate having that say Harris/Oakmark. You will recall when we selected them, their name was Harris. And so anyway, the reason I'm not big on the name Oakmark is that that's actually the name of the retail brand in Canada. And this is not a retail account. This is an institutional account. And so I just don't like the confusion there. But that being said, that's a branding exercise that they need to go through still. So Oakmark came in on the quarter, an underperformance of 60 basis points or negative 0.6%, absolute return of 5.4%. And then if we look at Fiera, which is a highly concentrated portfolio, that came in at an outperformance of 1.9% and an absolute return of 7.9%. I would say that all these managers are high conviction Aon managers. There is no substantial news that basically changes things for any of these organizations that are on the list from fixed income to equity. So I have no real update there. I do acknowledge the fact that Harris did go through a corporate merger in 2020, and that's not new news, or should not be new news to the group. Actually, Colin, it might be new news to you, but for the rest of the group, we've talked about that in the past. They remain high conviction to us.
Brian,
yeah,
can I ask a question? So, Oakmark has underperformed by 20%. That's pretty dramatic. Now, I get it that these numbers don't include the significant months of October and November. But if we had a view on October and November, what would the underperformance be, assuming that they've participated in the recent rally?
Well, as per the discussion we just had, they actually bounced back in October and November. That's what came out in the presentation. So stylistically, value has really hurt them. And so the value market being underrepresented in the overall performance of the marketplace, they've been impacted by that. They go for pretty deep value. So they have had a greater impact than your average value manager, but we have done due diligence on them and we continue. So I'll show you in a moment because it's on the other presentation, but we continue to hold them as a buy rating. And that, given the organizational changes and what's gone on there, they've been under the microscope and they are a high conviction manager for us. You will absolutely have managers that will underperform. And I'll give you an example. Fiera, that portfolio is a high concentration portfolio. And there's periods that it doesn't look very good. They only hold 20, 25 stocks in that portfolio. So they really have the ability to show their skill. But there'll be times that you kind of have to, hold your breath a little. And that's just the nature of the beast.
Well, I'm definitely holding my breath then, because I would say 20% underperformance This board doesn't have to do a lot, but I think when there's 20% underperformance, this board needs to really pay attention and have a conversation about that.
Right.
That's where I think we have a responsibility more so than any other decision that we make. And so I turn it over to you, Mr. Chair. I don't want to hijack this, but we probably should discuss this in greater detail.
Are you finished, Brian, or do you want to keep? What do you have to cover?
Oh no, I've got about another hour to go. No, I'm kidding, John. Kidding. Listen, let's go back to that presentation. The long presentation. So the Toronto Investment Board Performance Monitoring Q3 report, Jonathan, please. And if we can just go to page 3, that just covers off the long-term fund. And so the long-term fund, we've come in at 1.5%, which was a underperformance relative to the benchmark. Keep in mind that the total fund benchmark represents something different than what our allocations are at. So, for example, I'll just give you a verbal. We are currently overweight fixed income by, as of September ending on this particular fund, by 15%. And the reason is that we're underweight real estate by 10%, and that there's an equity allocation that's coming down the pipe, which I think we're going to talk about today. Are we not, Randy?
Yes.
Yeah. Okay.
Yeah, that's correct. This is the next item, Brian. I'm going to bring everybody up to date with that. So, yeah.
Right. Perfect. So all that will change. And so if we continue on the fixed income side, this particular mandate in fixed income, I'll remind you, is a universe mandate, whereas the others are sinking funds and they are a customized benchmark. This one, you can see that Connor Clark and Lunn and Leith Wheeler have both outperformed on the quarter relative to the benchmark by 20 basis points. And then the storyline is very similar to the equity content. Keep in mind that these equity portfolios, if you look, I guess it would be the third column from the left, you can see the percentage allocation through the whole portfolio. And 4.5%, 4%, 5.2%, 4%, and 4.5% for the 3 managers. That's the allocation respectively for Pier 1, Oakmark, and Fiera. So it's a smaller amount relative to the fixed income portfolio. The only other thing I was going to say to you, 2 things. One is, and this isn't going to help you, Matthew, but at the end of the day, we have a very, very short track record for these managers. And so we really have to assess them over a longer period of time. That being said, if you want to have a discussion, that's prudent as well. All these managers continue to be buy rated and held in high review, high regard, I should say, by Aon. So I think we're in a good spot.
No, Brian, I think that's sufficient. I wasn't necessarily suggesting we do anything per se, other than to, make note that this underperformance is, stands out, and that it's something we probably need to continue to monitor very closely, I would suggest.
So my view on that is if you're feeling that sort of thing, you should put it out on the table, because probably 66% of the other people in the room are feeling the same thing, but maybe just not putting it forward. So I think it's always a good discussion. Anyway, that's the core of really what I would say, John, and maybe we should just open it to questions.
Okay. Is there any questions of either Randy or Brian on the sinking fund performance, et cetera?
It's Sharon. I would just follow up on what Matt's asking. It's kind of what I'm hearing is we're just still happy with the managers, but what steps do you take when a manager is underperforming to that extent? What is the process? What do you as the consultant kind of do to monitor? Because the advice we're hearing is we just need to keep monitoring and we're still happy with them. And I guess what I'd like is something a little more specific in terms of what happens when a manager is that far underperforming.
Well, So the direct answer to your question, Sharon, is that our research group monitors them closely. There's a regular routine of assessing these folks, especially when you're on the buy list, which they are on the buy list. This is a manager that's held by a number of our clients, so you're guaranteed that we're keeping a close eye. But if you're looking for a specific schedule of events, I don't have that. That's in our research group. For the purposes of this group, I guess we have to continue to have this discussion on a quarterly basis when we meet to make sure there's no additional concerns. You know, I understand the problem with the underperformance, but I also get concerned if they bounce back and they outperform by 16% next year. That's an indicator of volatility. And so I don't expect these guys to bounce back as fast as people maybe would like. It's possible. But so Sharon, the direct answer to your question is our research folks follow these guys on a regular basis.
So I guess if I could just follow up, Mr. Chair, it would be helpful if you could provide us some information from the research group to let us know what, like, do they compare them to other value managers? Like, what steps are taken by the research group to monitor? I think would be helpful for us.
Okay. Good point. Any other questions? Okay, I have a motion to accept these reports? Matt?
I'll move.
Matt or Sharon, thank you. All in favor? Carried. Just before we move on from this item, and really reflecting on what we've heard from our two previous managers, in the last month or so, I've had discussions with the staff and with Aon just regarding the extraordinary events that have unfolded this year. We've had the COVID-19 pandemic. We've got zero interest rates, or if you're in Europe, you can have a negative mortgage. And their impacts on what is, in our case, primarily a fixed income group of assets, their individual impact and the interaction of them. And just to refresh your memory, the planning basis of this board, including the risk profile and the return expectations, were developed 3 to 4 years ago, first by Morneau and later on when Aon came aboard. And they were based obviously on the data available at the time. I'm not sure, but I don't think there was a pandemic built into the plan. And I don't think zero interest rates were built into the plan. So the question I'd like to pose to the board today is whether at our next meeting, we should have a gut check on where our current approach is going to get us in terms of what the city needs. And the city, as you're aware, has a rate of return need to the budget, et cetera, which Randy's talked about, and it has its own specific risk profile. So if you agree with all of that, what assignment should we be giving to the staff and or Aon to bring forward to the next meeting of the board for discussion and possible action? So I'm sort of looking for, because of the unusual structure of the board, I haven't had a chance to talk to people, but I've certainly been thinking about it a lot, and I'm sure you have, and I'd love your input, and if Sylvia could capture it all, and what direction should we be giving Brian and Randy and Betsy and others as to what should we talk about at the, whatever it is, March, April meeting of 2021. Any comments or thoughts? Colin.
Yeah, so I'm full agreement. I was thinking about that over the weekend. John, I'm fully there. I think we should. I think the tougher question is what assignment would we give? And to me, it feels like it is some element of scenario analysis has to do with the yield curve in some form of way. And it's just a question about what is the depth of that steepening over time, and what is the sort of absolute level of interest rates increasing, and what's the impact on our ability to hold to that first objective that I saw, which is to preserve capital value, right, of the portfolio. So to me, the biggest question is what less prognosticating about how much interest rates may go up. It's more, I guess, a scenario analysis around what is the magnitude. At this rate of increase, there's that level of impact per se on the portfolio, and also just given how we're invested, a lot depends as well on the shape of the yield curve and how steep that might get.
Good point. Any other thoughts or suggestions? Matt?
Yeah, so I want to pick up on, I guess, what Colin was saying about interest rates, and one of our presenters talked about, the folly in trying to predict interest rates and where they may go, and many careers have been ended on calls around that. But I think that's something we should talk about. Like, what are the large secular trends, not only related to the pandemic and post-pandemic world, but related mostly to things like demographics, asset values, low interest rates, that are the 10 or 15-year trends. Not that you can predict that far out, but that I would really like to see, some thoughtful commentary on that. Because I feel like while it's important that we hear presentations from managers and understand, the fund flows and the funds, I really do think we need to spend time as a group talking, to your point, more philosophically about where we think things are going and how we should be positioned, in light of that. So those would be some of the things. Maybe as a point of order, I'd like to understand, if there was a way, after this meeting, that we could suggest a few things to share with the group, how you would propose we go about doing that, John.
Well, I think if any of you have any ideas afterwards, or you have a couple cocktails later this evening, feel free to send me an email, or Randy an email, or Brian an email. And we're going to certainly accumulate all that material as we try to give some direction to the staff and to Brian for our next meeting next year. More the merrier.
Chair, this is Sylvia. Apologies for interjecting, but just on a procedural note, we appear currently to be between items. Can you just confirm, please, for the board, which item we are currently on? Because if this discussion is leading towards any recommendations, they will have to form part of that item. So just for clarity, please.
We're continuing really with item 10.2, which is broadly performance and, whether our structure now is going to meet the city's needs going forward.
Okay, Chair, that...
Sharon, any thoughts, or Pamela?
Yeah, so what I'd like to hear is also Randy has been sending us some invitations to various events. And so I think Randy is likely seeing a whole lot of stuff. Would be interested in kind of his views. There's just so much out there that I'm not sure how to corral and harness kind of where we go with this. But I think it's a very important idea. I think perhaps not with cocktails, but perhaps without cocktails. But I think it is worthy of a further thoughtful process by people to send ideas in. I just don't want to overwhelm Randy or staff with kind of a whole bunch of ideas. So I'd just be curious if Randy, after the board's spoken, if Randy could give some thought in terms of what he's seeing and kind of what his ideas are as well.
Yeah, Pamela?
I echo what Colin said at the outset. I think it's some kind of scenario analysis, and what I would ask, and I'm happy to Randy to talk after as well, is what is the outcome we're trying to seek? And I think if we focus on what the path we think might be, will be that will help guide staff in terms of the analysis that they undertake and the scenarios that they look at, so that they aren't doing the wild goose chase or trying to boil the ocean, or choose your metaphor or analogy that makes sense. And I think really, what are we going to get out of this? And so what are we going to do about it are the two important questions that we really need to ask as we conduct analysis.
Randy, any comments or?
Yeah, I can add and give a little bit of history. I know to do sort of this asset mix review, when we did the original asset mix setup, it was envisioned that, we did this split between 70% fixed income, 20% global equity, and 10% real assets, and that it wouldn't remain that way forever. The former CFO had the saying that you got to crawl before you walk, before you run. We were 100% fixed income previously, and just about every municipality in Ontario still remains 100% in fixed income. I actually had a call this week from the Municipal Finance Officers Association saying, what do you do with these low interest rates? And, a lot of them have been making money for doing nothing, just sitting in these high interest savings accounts. But I think if we go back to that original asset mix question, and it really becomes also a review of the risk profile. I don't know too many people at the city that would want to increase risk to get a higher rate of return. So, there has to be that element to it as well. You say, well, to maintain this kind of 5% plus rate of return, we would have to maybe shift the asset mix to, to be more of a 50-50 blend between fixed income and an equity, or 60-40, whatever it would come out to. But it's obviously going to have an impact on risk. So I think the initial question has to be, does the city want to even consider a change in the risk profile? And usually the gatekeeper there, when we did it originally, was the CFO and the city manager would propose it and make changes to the asset mix in the council approved investment policy. So that would be sort of the steps to go through, or the gates to go through, in order to consider this. I mean, Aon could always do a study and say, given your current asset mix, here's your risk profile, which I don't think that's changed at all, but the return profile going here, which we use in a lot of our forecasting, is a long-term rate of about 3.8% on the overall portfolio. From this point on, we think it might only be 2.4 or 2.1. And I guess that might be the first question to ask is, given the current risk profile we're in, are we expecting to, or can we live with a lower return on the overall portfolio? The other thing that's driving returns, which this board doesn't see, is there's almost an equal amount of cash sitting on the sideline that our staff, my staff, looks after, and those interest rates have really dropped. And so on that side of things, it definitely is a drag on performance. So that is another factor in all of this, is looking at this cash profile that we have, which really doesn't concern this board, but it would also come into the consideration for the overall asset mix and questions between short-term and long-term funds. So there's several different elements to this.
If I could, Mr. Chair, just follow up on that. What about reevaluating risk for a lower interest rate environment, though? Are bonds and fixed income actually as low risk as we once thought they were, if we're in a changed environment? So if we're looking kind of, when we did that, fixed income was considered perhaps less risk, but if we're going to negative rates, perhaps fixed income isn't the low risk that we once thought it was as well. Like, is perhaps one direction to go is reevaluating the risk profile of each category as well? I mean, I don't know if that's something that's being done out there, but it seems to me that if there's going to be inflation with low rates, perhaps income's not as low risk as people once thought it was.
Mr. Chair, can I just comment on that?
Sure.
If you wouldn't mind? So that's a very good question, because the fixed income portfolio is a significant portion, 70% of the overall portfolio. And the assumption that was put into place for the long-term fund was that universe was the right mandate. But the reality is that if we get into an environment where it's a rising interest rate environment, and I will point out that Bo from SeaWorld really didn't have that impression, so I thought that was interesting. But if we get into a rising interest rate environment, that portfolio is going to have negative returns. And we do have an active mandate, so the managers are going to do their best to, two managers are going to do their best to defend against that. But in that type of scenario, is it something like, is there some interest in maybe moving that mandate to a short-term bond mandate? Or trying to bring in further diversification to protect against that. So you do have a lot of eggs in the bond basket right now. And I think it is a good discussion to question that. Now, I should say, Sharon, too, that the other portion of the portfolio is in the sinking fund. Obviously, that portfolio is designed to basically meet its obligation at its end date. And so it's being managed a little bit differently. Buy and hold is an option in that portfolio. And so the circumstances of the long-term fund relative to the sinking fund is a little bit different. But still, 70% of the portfolio, it's certainly worthy of some discussion.
Randy, I don't know whether Heather's still on the call, but there's two elements here. We talked about risk and return. You know, we might put return in Brian's and Aon's bailiwick in terms of expectations and, yada, yada, yada. And I'm going to put risk into your bailiwick and Heather's in terms of the risk profile of the city, which, based on all the material I think all of us have got, is there's very little tolerance for risk. But then, and that may have been fine when candidates were yielding 5 or whatever. But in the environment we're in now, does the city say, fine, a no risk world is fine and we'll just suck it up with low returns? Or will that force some change of mind? So maybe from a discussion point of view, Brian can do work in Aon in the area of potential rate of returns and scenarios and yada yada yada, and you can have a meeting of the big poobahs at City Hall and explain the realities of life, and get some sense from them that when it comes to risk, they're not moving, and we as a board have to suck it up and say there is going to be no appetite for risk taking. And, you have to adapt yourself to that, or perhaps they will adapt themselves to taking a little more risk because they need the return.
Well, I think that's the exact conversation that, Mr. Chair, that we need to have. I think perhaps for the next meeting, if we revisit some of those assumptions that both Morneau and Aon did. Brian checked Morneau's work, and maybe go through a review of those. And I don't know if Brian can provide something that would give an update to that, like whether those assumptions have changed, the outlook for those asset classes. It might provide the initial a bit of work that that I could go forward on at the city. So and take it to Heather and the city manager to see what the risk appetite is or the return expectation is. That's what it really, I think, comes down to.
Brian made a good point. I think right now, when you present the 2020 report to the city, they're all going to think creating the Toronto Investment Board was a fabulous idea, and all of us members are really smart people, and John Tory's going to say nice things about us. And then if Brian is right and there's some more inflation next year, your 2021 report isn't going to be a lot of fun. And they're going to think we're idiots. So, how do we try to avoid that, or at least make everybody aware of the facts of life? Well, maybe if that's enough discussion on this, feel free to channel your suggestions, questions, ideas to yours truly, or Randy, or Brian, or all of us, and we'll try to capture that in some items for the next meeting. And we'll ask Brian to focus on the world out there and the environment, et cetera. And Randy can sort out the politics at City Hall, and we can try to bring all that together. Does that sound reasonable? Taking sure. No noise, I'll take it as an agreement. Let's move then. Sorry?
Chair, this is Sylvia speaking. So if the board is giving direction to the management consultant, I would recommend encapsulating that into a brief motion that can then be brought forward as action to the next meeting. 2 points on that. The board just adopted item 2, so we would need a brief motion to reopen item 2 and then to put forward a recommendation. So I am in your hands as to the wording, but if you and staff, if you and Randy or Betsy would be able to encapsulate, I understand that we're asking Aon to
I don't think we're asking for a new recommendation. I think we're just asking Brian to continue to do what he always does. This is Brian's mandate and his job, and he understands it, and I think he's just going to go and do it. I don't think there's like a recommendation we're putting forward here, is there?
No, I think
it doesn't need to go to council or anything.
No. My because of the bizarre structure of the Toronto Investment Board, I wanted to get input from people recognizing that COVID-19 is probably one of the great events of our lives, and zero interest rates have a potentially significant impact on the assets that we are dealing with. For this year, it's worked out very positively, but I'm concerned that unless we kind of revisit the risk and return issues, life could be more unpleasant in the future, and you see whether we can find some ways to mitigate it through, perhaps some type of policy changes that might occur in 2021. So I'm not sure, Randy, whether we need, to Sylvia's point, a motion on this, or whether everybody understands what they should be doing. What's the best parliamentary approach here?
Well, I'll fall back to Sylvia's. I think if you'd like to see something at the next meeting, I think there needs to be some sort of motion, if you like, or wait till the next meeting to see what we can sort of pull together and then review it at that time. But I think what the clerk is asking for is, if you wanted to see something at the next meeting, then there should be a motion to say, even a one-line type of motion to say that the Toronto Investment Board would like to review the risk and return profile of the asset mix for the next meeting.
Yeah, that's fine.
Could we just add one phrase there, in light of COVID? Because I think what, John, you're suggesting that we are asking for this in light of the impact of COVID. So just put that in there. If it was to be kind of unraveled years from now, that's why we're asking for a review of risk and return. So just what Randy said, I think, is great wording, just adding in light of the events of 2020 related to COVID or something.
Yeah, well, maybe if we could have a motion to reopen 10.2, or I'll make that motion if everybody in favor. Carried. And then back to Sylvia, you just heard what Sharon said, and can you encapsulate that in a couple of words or a couple of sentences?
Sure.
Or can you, Sylvia, can you put it up on the screen for us to read?
Yes, just give me 1 second and I will ask my colleague to display that for you.
Going on your protocol, John, on kind of normally what we do in the meeting, I think is put it up. So that's why I'm not
Right.
trying to be difficult. I'm just trying to follow our regular protocol
No,
here. Help you out with this parliamentary process, as you call it.
No, Chair,
Sylvia's the boss. I'm in her hands.
we will display the motion. Chair, if you could confirm the title of Brian White with respect to the committee, so I get that correct in the motion.
He's an advisor to the committee. Is that right, Randy?
Yeah, it's the investment consultant. Yeah, I'd probably say something like the investment consultant in conjunction with consultations with city staff to do an asset mix review for the first meeting in 2021. Or the risk return profile of the asset mix at the first meeting.
In light of COVID, the events of COVID.
Yeah, that's right.
Okay, so I did drop something up. I'll ask my colleague Jonathan to please display that for the board.
How does that sound to everybody?
Looks perfect for me. I'm willing to move it if it works for everyone else.
Is everybody comfortable?
I'm comfortable.
Okay, that's Sharon's moved it. All those in favor? Carried. Thank you very much, everyone. Let's move to 10.3, investment manager update. Randy, and since the meeting's running long, why don't you try to run brief?
I will be very brief, Mr. Chair. 10.3 is the investment manager update. It is another report for information, but it does have one recommendation: to adopt the attached investment plan, which is on attachment 1. It really just announces our new global equity manager, legal and general investment manager, LGIM. It is a passive mandate with a multi-factor model that has an ESG screen. It's really quite exciting, I think, and you have to realize that the weight of this global equity manager, this passive mandate, will be equal to all 3 of those managers we just looked at. The investment performance, each of those are about 3.3% of the fund. This will take up a full 10% weighting of the both portfolios. The documentation has been signed. I have to thank the chair for going out of his way to making sure we had both the virtual signatures as well as the real signatures to get into LGIM, and we're just now lining up a funding date for LGIM. I did want to point out there is in the report some of the things. This is a multi-factor model, and we did. There are some screens, ESG screens, that if Brian can jump in. I borrowed these in the report. In attachment 2, Aon had a flash report. I believe we showed this at a meeting previously when we were in camera. But there are core themes around responsible investing. The main focus is climate change, but it also addresses a number of global social concerns. One main factor is to reduce the weighted average carbon intensity, which by approximately 46% of the index carbon intensity. There excludes coal companies. LGIM has a client impact pledge. I'll let you read that on your own. There is a link in the report. On the social side, they also exclude any makers of controversial weapons, such as anti-personnel landmines or cluster munitions. They also exclude manufacturers of tobacco products. They also, if there's anybody that violates the UN Global Compact, they recently, Elgin, there was a Bloomberg story where they were reviewing over 1,000 companies that they felt could do more in the area of ESG. So they're very active, even though they're a passive manager. They're also very active with their voting procedure. When we interviewed them, they showed us some interesting numbers, how they vote their shares with some of these important changes on the ESG front. So I think it's an exciting announcement. It took us a while to bring them in, but we're now at the point where we're just about to fund. It should be next week. We are lining up, I think, December 14th for the date to do that. I will point you also to the I believe it's attachment number 3, which is the overall structure of both of the funds. IB 10.3 attachment 3. Again, there's 2 tables, the long-term fund and the sinking fund. The long-term fund currently has cash available of $736 million. So half of that, roughly, about $380 million. Scroll down there, Jonathan. We will be putting half of that to work with Elgin, and the other half, of course, will be for real assets when we get to that. And then over on the next page, the sinking fund has about roughly $200 million in cash. These numbers are as of November 13th. I think it's actually $208 million. There's also some rebalancing to do. I mentioned in the other report, when you scroll down to the cash number there, that we have $488 million. And again, we'll be reducing that by about 14%. There's about 4% rebalancing. There's actually a little bit more. And then 10% will be going to Elgin to kind of bring you up to date there with the full funds. At that point, I'll leave it there, and it really just needs an approval of the investment plan, which really just inserts the name of that last global equity manager.
Any questions of Randy? Well, could I have someone make a motion to accept this report? Matt, thank you. All in favor? Opposed? Carried. We'll move on now to item IB 10.4, real asset update. We have a staff report on this with a recommendation. And again, we'll turn it back to Randy. And also we have the Aon group also here, if there are any comments there. So, Randy?
Right. And this, again, similar to our last meeting in October. This is just a covering report. The board had asked on this area of real assets to be updated. And so we have Aon and Kurlos. I don't know, Brian, did you want to take over? There is a presentation that was an attachment to this report, and I'll let Aon take over.
Sure. Brian, why don't we assume people have read it and just highlight a few of the select points, and then we perhaps can have some discussion.
Perfect. So I'm going to turn it over to Kurlos, who's the expert in real estate. Kurlos?
Yep.
Very quick highlight.
No problem. So we can make this really quick because last time we had this discussion was about 2 months ago. And so there are not any major changes between what happened 2 months ago and now where our outlook, our real estate might be. The same accelerating trends that we noticed then are still apparent now, i.e. e-commerce is still filling those COVID-19 gaps, meaning that more and more people and more institutional managers and more large sponsors are using these warehouses, and they're filling them up with different things in order to meet the demand of e-commerce, which has grown. And we feel like that the e-commerce takeover, which started before COVID, accelerated throughout COVID, it is here to stay, at least for the foreseeable future. So we still like industrial. We're still looking at the industrial space. I think Colin last time asked me a question about cap rates concerning the industrial space, and we said we saw some deals in the high 3 cap rates. Since then, I think we've seen some more. So there have been some transactions that continue to take place, large portfolio acquisitions in the industrial space. Another happening in Canada here shortly. So there still seems to be good, robust demand for industrial. Other accelerating trends are where people are living and moving. Given that given that COVID has given people the ability to work from home, they've been choosing where they want to live, and so now all of them are living in those primary gateway markets. Is this the death of cities? Yeah, I don't think this is the death of cities, and I don't think that that's what we're saying per se. It's hard to know at this point. I think there have been multiple points in history where people would point out the death of the city, but it still kind of resides and kind of continues. It just now you've got this older millennial cohort that are starting their families and want more space, and so are starting to rent homes, single family homes that are being rented. The reason why they're renting is because although they want to be in bigger spaces, there are barriers to entry like down payments, which they still cannot afford. So they're renting these single family homes. So the single family home space has become something that we've been looking at. Work from home, de-densification, those are things that we're watching. How does that affect office? Office is always the big part of the story. It's the big puzzle that people keep questioning what's going to happen to office. There are several theories out there whether or not there's a resurgence of suburban office. We will see. That was a 4-letter word for a long time, and now it's being revisited as a possible investment strategy. Why? Because those office assets are usually bigger, larger plates, and you can get more people in more of a spaced out environment. People are going to be asking for flexible working environments. People are going to be asking for different ways to work. So office still remains a question mark. I think our thoughts are still that the best office assets in the best locations may survive. You will see some office assets be affected from a valuation perspective. Hotels, we're still watching the hotel space. That's a smaller part of the entirety of the private institutional space, including in the U.S. It's gone down quite a bit in terms of, our Odyssey funds, which are the majority of our investment base. But that's strictly tied to COVID, right? The travel has been restricted. More resort areas have seen some uptick. If you've been watching the public markets, there's been 50% of the deficits in the hotel and retail space have come back over the last 2 weeks, and that's just based on news of the vaccine. But because there's this big disparity between public and private pricing, we're still not comfortable with the private pricing on hotels or retail. So we take a pause on things like legacy assets and investing in managers, open-end managers, at least for this specific point in time, that have legacy assets in those spaces. We're looking at the world in its entirety. We're still looking at sector-specific managers who are looking to execute in the data center space, in the industrial space. Data centers, because it's tied to our data, and because we're on a WebEx call right now, and every other call I did today was Zoom or Teams, we're using more and more data. For the first time ever since I've owned a home, or since I've been married with kids and the whole thing, I got a message from my data provider saying I'm going over my limit for the first time ever, because now they're starting to calculate and time these things. So I think data centers, it remains a part of the conversation. Industrial is still something that we like. We like managers who are in the space today that are taking advantage of any dislocation that they might see. And now we're starting to hear stories of 2021 and how the 2021 story might play out. To Brian's point, vaccines are here. It's going to take a long time to roll out. Not everyone's going to get them, so it's going to be a little bit longer of a story here before things start to normalize. So we're looking at more managers that have blind pool or have not yet invested $1 in any of their funds in order to take advantage of the dislocation, unless of course they were investing in the team. So that's kind of high level, the high points, and I'll stop there and see if there are any questions.
Curious, as John, have the write-downs run through the sector in your view yet completely?
Not completely. Again, we're still seeing a big disparity between public and private pricing. I think that you're still going to see some write-downs in the retail space. I think you may still see some write-downs in the hotel space if they continue to remain closed. So there's going to be some write-downs with these diversified managers who invest in retail, invest in hotel. And again, there's that office story. What's really going to happen with office? So I think you're going to see some write-downs based on just kind of one, transactions, right? What is actually being transacted in the space? Are we going to see transactions? Two, what are those transactions going to look like? And I'll get real life example. There's a large manager here, operator here in the U.S. called SL Green. They sold two Manhattan assets recently, and both those assets were sold at a discount. This is public news. So one was sold at a 10% discount, and one was sold at roughly a 5% discount. And both of those assets are really good, really large assets in Manhattan. And that was actually a good news story because people thought that there was going to be even bigger write-downs. So, we don't really know in terms of office, but what I'll say is you'll likely see some write-downs across the space. You're going to see some debt disruption. You're going to see some kind of dislocation that comes in, I think, in the first quarter as more and more things start to make their way through the system. Whether or not stimulus packages are coming to fruition or not. There's so much that's happening in the macro environment that can affect valuations that I don't think you've seen the entirety of the write-downs. I think you've seen a lot of it, but there'll likely be some pain points in some specific assets over the next several quarters until this vaccine is officially rolled out.
Okay, any questions? Any other questions? Colin, since you're our real estate expert, do you have anything brilliant to raise? Any secrets? We can't hear the brilliant question, Colin.
Can't hear it.
Still muted. I don't know if it's mute or it's can't hear you.
Yeah, we can hear you now.
Okay, per Carlos's data point, I'm sure I think I'm having data issues with my computer. All I would say is I actually partly agree. So I do think that across the spectrum, I think Carlos is spot on in terms of the assessment, and I certainly agree with the trends as listed in the document. I think well-located office, as Carlos said, is going to perform better. I know there's a lot more focus on suburban office strategies now. If I were to step back from that, I just say the public markets have gone through this COVID, it's good. Now we're coming out of it, perhaps, and you've seen the stocks react to that. I do think that the real estate world is going to avoid that volatility per se, but it's not going to be immune to that volatility. And certainly the real estate world has an assessment today of what's attractive, and it's not clear to me if that is going to be the same assessment in 6 months as to what's attractive, right? Because we're clearly in one frame of being today, and we're going to be in a different frame of being in 6 months. I would say the longer term trends that Carlos mentioned, millennials looking for bigger places because they're having families, and the affordability of owning, I think is a much bigger and important trend, including as to where people live relative to the are we all going to be working from home in the future discussion that seems to dominate real estate today. Going forward in a year, I think we're going to have less discussion on those things and a lot more discussion about, what does immigration look like in particular cities, and does it compensate for the fact that people are going to start, looking for bigger homes because they're having families, and that millennials are all just going to move out. So that's my 2 cents to add to Carlos, but I agree with all the everything that he said.
Okay. Any other questions of Carlos? If not, can I have a motion to accept their report from somebody? Pamela, all those in favor? Thank you very much. Thank you, Randy. Thank you, Kyros. Thank you, Brian. Thank you, Rega. Wonderful. And we will now.
John, could I just ask one question of Brian? I think Colin has.
I missed who did the motion. I couldn't tell who.
Oh, Pamela did. Colin has very kindly taken the mantle of asking about gender diversity. So thank you, Colin, for taking the question I was always asking. But I don't think we've actually ever asked the question of Brian in terms of diversity at Aon and diversity on kind of what your firm does for diversity, and especially both kind of all types of diversity. I think Colin's been asking about gender, but I think we've never really come back to you on what you look for in diversity, both within your own firm and the asset managers you're selecting for us.
So the direct answer to your question is Aon is very involved in diversity. It's one of their biggest mandates in 2020, and that is gender, cultural, orientation, all of the above. It's completely inclusive. With respect to, I'll just pick on our office in Canada. We have our offices in Canada because we're from coast to coast. We have it's either a 45 to 55% female population, and in terms of the cultural and orientation diversification, I can tell you that we are vast on that front, but I don't have specific statistics. I can't tell you the statistics in the US, but I can tell you that it is a major focus in the US. In the UK, which is, I guess for tax reasons, but is now our head office in London, even though functionally it's out of Chicago. But the UK is probably even further along in terms of diversity. With respect to hiring of managers, that's a good question. I've never been asked that. So it is something that comes up in discussion. But I would say that we do not exclude managers because they are not diverse. Yeah, I've never been asked that question before, Sharon, so I can't tell you for sure, but I can tell you the practice has been that we have not excluded people. So our client base is quite diverse and have different views on things. And so as a result, we sort of cater to the masses. If you had a very specific mandate, whereas I'm just going to throw out a number, a 50% requirement for a female population within the organization, we could cater to that. But I have never, in my history at Aon, been in a search where we've excluded as a result of gender or any specific personnel criteria. So I don't think that's the answer you want, but it's true.
Okay. Well, I think we have to start asking these questions. We may like the answer or not like the answer, but I think if we don't start asking the questions, we'll never move the dial. So perhaps the takeaway is to go back to your firm and say, you have been asked, and what are we going to do about it? So that would be appreciated. Thank you.
I will, absolutely.
Can I just add one thing to that, Brian? I'm sorry to interrupt, but I would say that we do have initiatives, although we haven't excluded managers, we do have initiatives on the other side of that. So our MWBE initiatives and minority and women-owned business enterprise initiatives, where we're looking at more and more managers who are MWBE owned. And so I would say that although no one's been excluded, there are mandates and initiatives on the other side of the coin where we're being proactive about seeking out and looking for managers who are MWBE managers. We have a head of emerging and MWBE manager research, and so that person is looking across and trying to unlock more and more of these types of managers. So we do look at them. We do consider investment with MWB managers, but just want to make sure that you all were aware that we are looking at it from that perspective.
Okay.
Thank you.
Thank you.
I just wanted to add one thing, Mr. Chair, if you don't mind. Just to that point, the City of Toronto is actually about to release an ESG report on the City of Toronto that addresses all of these concerns, both in environment and social and in governance. And it was supposed to go to to executive committee this week, but they bumped it to January. But I've seen the report. We had a pretty big hand in drafting it. I know all the major corporations now are issuing, with all the banks, insurance companies. I've seen a number of large-scale corporations that are doing ESG and committing time and resources in reporting this under certain standards to provide investors with ESG. Brian did set us up. Maybe it's just being a little modest here. They do have a product that is kind of testing the portfolio managers' ESG, sort of statements, and then testing the outcomes of that statement. So it was very interesting. It's sort of, I guess, just in beta form. Brian did set us up, the staff, with looking at those kind of managers that, it really prevents that greenwashing, people saying that they're in line environmentally, socially, and governance, but as well looking at the outcomes and comparing them. So Brian thought it might be a solution or another way of approaching our whole ESG scoring that we have to, that should be coming early next year. So just wanted to add those couple of points.
On that point, Randy, maybe at the next meeting, because effectively, the city is the client, and what you've just outlined is sort of the city's expectation. So maybe we should, as a board, have that in front of us and saying, when these are the instructions that we give to Aon in terms of the managers we deal with, and we expect Aon to carry out that in terms of, the ESG or other aspects that the city expects, or the city expects us as owners of assets for them. Maybe we could have something from you, and then on Brian in terms of, I assume, the capabilities of Aon to meet that. And there's nothing, we hope, in what the city's doing that says, holy, that just eliminates most of the investment environment. But that you have the capability as an organization to deal with ESG or diversity or other issues that may come out of the city's policy. Maybe we could put that on the agenda for the next meeting, Sylvia. Okay, anything? Are we okay to move on, Sylvia?
Chair, did we take a vote on that last? Oh, we did. So there's one.
We okay? Can we move on to the final item?
Yes, Chair. So that last direction, was that an undertaking for staff, or is that something that you wanted to formalize?
I don't know. I think it's probably, we don't need a thing on it. You just keep track, and we'll harass Randy and Brian for the next meeting. Let's move on then to IB, the final item, 10.5, proposed 2021 schedule of Toronto Investment Board meetings. We saw a letter from the board secretary at the beginning of the meeting. I'm not sure where we stand because Sharon, was it you? There was original dates sent out, and then you wanted to change some. So, where do we stand? Going back to the original?
Yeah, I'm fine with the original date. So I think it would probably be easier for everyone to just. I think everyone else was okay, and I'm now okay.
Okay. Can I have a motion, maybe from Sharon, to accept?
So I'll make a motion to.
Chair,
all those in favor?
Chair, just to interject, the letter before you represents the amended dates, not the original ones that were sent out. Following my request pertaining to the amendment, a quorum of board members replied and said that those dates were fine. So those are the dates that are currently in the letter. If the board would like to go back to the original dates, which has the 14th of December instead of the 13th, that at this point would need to be done by motion.
Just from my perspective, both are fine, John, so you can take it from there.
What's the easiest thing, Sharon? Sylvia?
I'm in the board's hands.
Well, if everyone's okay with these dates, let's just approve these dates then.
Yeah, it sounded like that was the easiest way.
Yeah, okay.
Okay, I'll make a motion to approve the dates before us.
Okay, all in favor? Good, carried. Well, that concludes today's meeting. I hope, wish everybody a happy holiday and an enjoyable holiday season. And I hope 2021, we actually have the opportunity to get together in the same room. Doesn't look like it maybe for the Q1 meeting, but keep your fingers crossed that, who was it? Brian, Brian has a friend who's had an injection, so maybe you can line us all up so that we can get to one of the benefits of being on the board here. We can all get a vaccine sometimes in Q1.
He's our guinea pig.
If he dies.
I'll be right there with you, John.
Yeah. Okay. Thank you very much, everyone, and see you next year.
Happy holidays, everyone.
Thank you.
Okay.
Yeah.
Thank you.
Happy holidays.
Bye-bye, everyone.
Yep.